So, okay. Tom, you ready? As ever. I'll hand you over to Tom Williams.
Thank you, Peter. Thank you, Rita. Tom Williams here. Lovely to talk to you. Right. Now, what we have on the screen is a daily chart of the S&P 500 future. Now, it will run in harmony with the cash, as we know. If I show you the cash, it'll be a very similar thing. Now, the two always run together. They have to run together because there's an army of arbitrage traders out there. And if there's any disparity between the two, they buy one, sell the other, and that's how they make their money. And it keeps it in line. So we're just for convenience, we're going to look at this future. Now, I believe we looked at this last time. All right. Right. And we noticed that it's obviously going uphill, look. Right. But we noticed too that it's slightly rounding over. Right. In other words, it appears to be getting tired. Right. Which is a characteristic sign of supply slowly hitting this index, right, which we mentioned I think last week, and you'll see that all these red down bars, traditionally these are tests, and you get an immediate, that's the thing is, you get an immediate response upwards after a test. Now, however, lo and behold, we look here, where is it? Here we are. Look. Lo and behold, right there, look, we have a test. There, the computer tells us we've got a test. We tell you it's a test. It's a test. Now, traditionally, once you see these tests, there it is there, on Wednesday. Now, what's slightly unusual for this S&P, don't forget, they have characterized, right, that's Monday there. That's Tuesday. We've got red arrows on there, look. Now, if they were bullish at that point, you'd expect the test on Monday. If they're really bullish, if you look back at these bars, you see, right, or Tuesday, but this didn't come till Wednesday. Now, that is definitely a test, right? However, when the market is hitting supply and is running out of steam, you still get the test, but we get what we call a fail test. And the fail test is when it doesn't respond to the upside. And lo and behold, Wednesday, the test, Thursday, little or no response, right, and Friday, today. Right. So we've got a warning here. This is a sign of weakness. A test. If it was bullish, you expect an upward move straight away. Now, we're going to move on to another chart, but are there any questions about that first? Rita's look at the screen, and Peter has got their own screens here. Any questions about that? Not yet. Got to give you time, I suppose. But that's a failed test. Nothing? Okay, fair enough. Peter, can we have a 4-hour chart up? Please. Now look, this is a 4-hour chart. right? Now what's interesting here is, yes, you've got some supply up here, look, red signals, but you've also down here got what we call stopping volume, look. What's that, Pete?
Potential selling climax.
Right. Now, it's not a true selling climax because there's not enough time there. But basically, the computer's quite correct. Professional money must have stepped into the market. Why? Because first of all, it's a down bar on a very wide spread, right? The volume or activity, this is the amount of activity that took place on that bar, is very high. And on that activity, bang, it closed almost in the middle. That's got to be buying for professional money, right? But however, we know, told you 100 times or more, you would normally expect that level. Now draw a line across there, look. That level where there was supply to be tested if it was going to be bullish. You'd expect this market to fall down to that line, area. And if the volume is low, especially if the spread is narrow, it means that supply that was there has now disappeared. If there's no supply, then it must mean that demand must be greater than supply, and you'd expect higher prices. So it's a 4-hour chart, look. Right, any questions about that one before we move to another chart? Reese's grunting slightly here. Something must be happening.
Winston says, I'm sure you said this many times before, but it was last week when I got it, and that is using the test to help you stay in a bullish trade. In a bearish trade, is there an indicator that will help us to stay with the trade that is as strong as the test in the bullish trade?
Sorry, say all that again.
Well, in a bearish...
In a bullish market, you get things like...
Yes.
Is there an opposite to that to help you stay in?
Yes, there is. You'll initially get weakness, which will appear on up bar, right? It'll have a signal on it probably. It'll be high, very high volume on up bar. And then, you see, if the market is really bearish, what it means first, they have to distribute. They have to unload their holdings and short. Do a lot of shorting and all sorts of things they get up to. This can take time, and they may have to hold the market up. But once a trend down starts, you'll see the bars are mostly red, with an occasional blue up bar, which would be on no demand. But we haven't seen that yet. We're still basically flogging away here, trying to go up. But on that daily chart I've just showed you is really the first fail test that we've seen, which is a sign of weakness, right, in its own right. But it's not a sign of supply hitting the market. We know that needs an up bar on very high volume. This will eventually top out this index, and you will find it'll top out on up bar on very high volume. The spread may be narrow, right, or it may be wide. It all depends on market conditions at that moment. but we'll spot it when it happens. It hasn't happened yet, but we can see it's climbing uphill. It's getting very tired, leaning forward, and we have definitely last Wednesday what we call a fail test. Can you put that 4 hour back? But this is interesting, this 4 hour, because right here you could see we had a red down bar plummeted down on a very wide spread. We notice that the volume or activity is very, very high. And we also observe it closed more or less in the middle, not to mention next bar's up. This must have been caused through professional money coming into the market. But we would expect that level down here to be tested, because the market works on supply and demand. All the time the supply here, it has difficulty going up. And there's the supply, look. Right? Now, we want to know whether that supply was absorbed, which it appears to have been, but to do that, we have to have a test. We expect these, a bar along here somewhere to fall down into this area. If it falls into that area, and you get low volume, especially if it's narrow spreads, that's going to go up. Now, any questions about that before we move somewhere else? Nothing. Good. Right, okay, now let's have a look. Let's have a look at, say, I must say, I must rather like these 10-minute charts. 10-minute chart, look. Right, just basically be moving sideways here. But you can see here, look, they rammed it up, right, signals there, rammed it up a little bit more, and then they turned around and rammed it down. They tried to go up, and they try to go down. They're obviously not quite sure, professional money, where they are. Or there's a fight going on between the bulls and the bears, and it's got to sort itself out. And how that would sort itself out would be if this was tested just like the 4-hour chart and the volume was low, then that means supply would have disappeared. Of course, if it goes up back into this area on no demand, or up on narrow spreads, no demand, then of course that shows it wants to come off again. Okay, so it's a 10-minute chart. So right now it's just going sideways, not doing much. Well, it's always doing something, but sign of weakness, that's what we call weak bar. There, this would be no demand, look. You can look at these individual bars. We must do a seminar on one day, because we do have what we call strong or weak bars, looking bars, where you can just look at the bar and it more or less gives you a rough idea whether that's a bullish bar or bearish bar. But this is what will bring this sign of weakness up here. That's a bearish bar. So that's a 10-minute chart. Any questions?
Question here. Would you say the daily ES chart is showing distribution yet, or would you not consider distribution until after the high volume up bar?
Well, right now it's running into supply and lack of demand. But you don't get serious distribution until you actually see the up bar on very high volume, and that tends to cap the top of the market. Then they normally have to start distribution. In other words, unloading more they're holding, shorting the market, and so on and so on. Very often they have to hold the market up while this is going on to sell more in the next wave up. But we haven't seen that yet. We're really in no man's land at the moment. Professional money, of course, they trade in their thousands of contracts. But they can do that because they have far more confidence than we do, because they're more in the know than we are. As a matter of fact, an individual that can't read or look at a chart knows really absolutely nothing what's going on. Yet professional traders, they have a lot of inside information. They can go with their group because they see other professionals going long or short. They've got screens showing where all the stops are. They know the overall supply and demand in the stocks, individual stocks as they're going along. There's a host of information that's available to them that we as outsiders never know about. And if you didn't have a chart, you wouldn't know absolutely anything at all. You'd be relying on this to the news about how Ebola caused a downfall and all this stuff. You know. So we're lucky to have charts. At least you've got a window looking into the activity of the professional side of the market. It's all there if you want to spend enough time and studying all these different time frames and keep it focused. The information's there because we can see it easily in hindsight. But the difficulty is spotting it all as the market's unfolding. That's why originally I wanted to develop this computer program, because computers don't get confused, they just do as they're told. You said this, you said that, so I'm coming up with a signal. And that's it. And you can see, if you look at these signals and say, yeah, they're not bad at all, then if that is correct, then it means that the information that we're telling you must also be correct. Because that's all we've told the computer. So we told the computer, if you see an up bar or down bar, do this or do that, and the volume's high or low, close here, and so on, throw a signal up. Computers just don't understand that your lack of knowledge. They don't want to know. You either get it right or not. Question?
How do market makers mark the price up? Do they essentially buy from themselves in an effort to find more buyers, so they move the price up?
Well, don't kid yourself. They don't buy it at all. They just simply mark the price up. I know in the currency markets they can do that. Some of these firms or people, they mark the prices up. And if somebody comes along and wants to do a deal on that price, they say, I'm sorry, that price is gone. They put the price up there or down more or less like an auctioneer can. If an auctioneer in a public auction, he doesn't have to buy the product and mark it up, does he? Or down. He's just testing the clientele there, the audience, shall we say. Is there any suckers in there? Can we get more money out of them? Can we fool them in some sort of way? I'm afraid that's what human beings do, if they can get away with it.
Yeah, we've got a question here. Could Tom discuss... All right, hang on. So Andrew is now saying, in that case, the market is not set by supply and demand.
Well, it is set by supply and demand. If you're a market maker, you mark the market up artificially, right? And you can see on the chart that it's gone up on no demand. It's showing you the market does work on supply and demand. I see what you mean. Well, they do it. I've seen the markets being marked up in 1-2 seconds. I've seen it here. I was sitting here watching the screen the other day, and suddenly on the stock.
This morning on the index.
Did it?
5 minutes, it was no demand for a buy markup. It came off.
Yeah, it flashes up perhaps 1 to 2 seconds, right, before anybody could react. But the fact is the price went up there means that all those stops could be triggered, right? Things like that. There's all sorts of skullduggery going on there. And you'd be very naive if you thought that didn't happen. I mean, they've been talking recently about all the main banks being fined heavily for this and that and all the rest of it. But that's what happens. That's what human beings do. Not just confined to banks. Imagine what the traders get up to if they get away with it.
Yeah. So Jenica is asking, how does the market maker change the price electronically?
Well, you just press the right button. Simple as that. Yeah, good. I mean,
right. So, but you can't mark price. This is Ben. But you can't mark prices up without an actual transaction occurring. Otherwise, it would just be raising the ask. Seems to me they would need to buy from themselves at a slightly higher price on low volume, trying to entice others at higher prices.
well, I can't explain all the ins and outs of how that, but I do know they mark it up. Whether they have to buy some for themselves or not, I'm not quite sure. But they probably may do, I don't know. But I know they mark it up. And they can also mark it down. I've seen them do it on the screen, where it flashes up just for 2-3 seconds, it's there and then off. You've got to think along these lines of what the possibility of skullduggery that goes on. You'd be very naive if you thought everything was all apple pie order and they were there for your benefit and they wouldn't do anything that might break the so-called laws and all the rest of it. You'd be very, very naive if you thought that. If there's an opportunity there, they'll take it. But they can mark the price up and down. I mean, look, if you were selling your house, right, and for whatever price, you could easily tell the agent, I'm going to mark it up. I want a higher price. Or I want a lower price. I'll take a lower price. Right? You can do that at will. And I'm sure they can. I know they can do it in the currency markets. I've seen them do it.
Colin is saying, Tom, you suggested that we will see the top out on the ES by a high volume up bar. Could a shakeout also be a possible outcome to the current sideways movement?
Well, it does have the characteristic of liking to have shakeouts, the S&P 500. So it's possible they may have a shakeout. But when we look at that 4-hour chart, put that 4-hour up again. I mean, you've got to believe the evidence that you can see. Now look, here, it's clearly, if you could tell me what else could cause that, I'd be pleased to listen. It's a down bar, look, widespread, right? That puts the fear of God into you anyway, if you're the wrong side of the market. We note that the activity or volume is very high, and on that activity closed almost in the middle, look. Next bar's up anyway, and that's a test, look, that black bar. Now, that's there. You can talk all as much you like, but it won't alter the fact is that's there. Now, we know that if it has to go up, or if it's bullish, right, it's going to have to test that volume. And don't forget we've got that failed test in the S&P daily chart. Right, so this market, if it comes back down to this, it's a level that's important, right, and the volume is low, especially if the spread is narrow. Like say we saw a bar similar to this black one here, look, here, and the volume was low, then that's going to go up. Because where there was supply, right, that can't go long or up until that disappears. So they test it. Now this is a long-term test, not a one-day test that we've been looking at in these daily charts. Now you can't deny the evidence. No matter what you say or what you think or what may or may not happen, doesn't make any difference. You can't deny this is there, look. That's professional money moved into the market, right? And you know the principle, it can't go up unless they test it. Okay? Any questions?
Well, Jay had asked, do you expect a test of that area? And if so, do you expect it today or Monday? Well, we don't know, do we?
Well, when's it going to rain? It's going to rain tonight, tomorrow? You don't know, do you? But the whole thing is that when or if it happens, don't forget the word if and when, right? If it happens or when it happens, you will recognize it. The light will go on, bang, then you'll skip, because then you have to go long. And you have to put stop underneath, preferably an odd number, and follow it up until the opposite comes in, which will be a sign of weakness. Does that make sense?
Okay, question here that came in early. Can you discuss bag holding, Tom?
Well, bag holding, when you see it, it's really fantastic, to be quite honest. It's one of the signals you could almost say is 100% certain. What will happen, you'll see a bear market, or at least a fall, a decent fall. Not 1 bar, 2 bars, but probably many bars. You'll see some stopping volume coming in, like we saw in this 4-hour chart. Right? Market moves sideways on that and perhaps starts to fall back down to the level. Then out of the blue, some horrendous, so-called horrendous news appears. Right? The Russians have done this, or they've done that, or the Arabs have done this, or they've done that. Some horrendous news. On that news, the market gaps down. It's a clear gap down, right, into fresh low ground. Right? But as the day wears on, you'll see that the spread is very narrow. And you'll also see that the volume is very, very high. This is bag holding. And what it means is that the market conditions have been such that when they marked it down on that bad news, it's shaken out as many of the weak holders as possible. Even people with nice good long positions that would be correct are frightened out of the market. Professional money absorb all that selling and say, right, thank you, I'm having that. Christmas has come early to them. That's bag holding. And if and when you see that, you could almost guarantee that market is going up.
Okay, so there are no more questions on the screen. If you've got it, all right, there are now. But in the meantime, if you've got any charts that you want Tom to look at, please put them into the questions box. So on the subject of bag holding, one comment is in bag holding, should the price stop there? And Donald is saying, so basically what you're saying is any price you get is not an honest price. It's either been marked up or down.
Sorry, Rita, say that all again.
So the first question was, in bag holding, should the price stop there?
Yes, if it's bag, should the price stop there? Well, it does. But it stops within the narrow spread, which may last all day, bobbing around within that narrow spread. It stops because professional money soak it up, anything that comes onto the market. Very positive sign of strength.
The other one was, so basically what you're saying is any price you get is not an honest price, it's either been marked up or down.
Well, we're talking about times when they do mark it up and down, which is not honest. But most of the time the moves are genuine. You have to have a certain amount of genuine moves in the market. But we're talking about a bit of skullduggery when it rears its head. And you'd be very naive if you didn't think they could do that. I mean, you've only got to listen to the news the last 2 days about all the banks. 5 major banks have been fined heavily for manipulating prices and doing this and doing that. So you tell me that individual traders, market makers, that don't get up to tricks themselves? Of course they do. But overall, because the VSA always looks at everything relatively speaking, so not pinned down to any one price or one this or one that. Right, and the computer's very good at throwing up these signals, warning you.
Pat, what index does, what exchange is RFMD? And while you're typing that in, US. RFMD, Peter, could you type that into the... We can do the daily charts. RFMD. Is it a stock, Pat? Edmund's saying it's the Nasdaq. Yes, it's a stock.
Is it Nasdaq?
Apparently so.
It's not a stock, it's index.
It's part.
It's a part of the Nasdaq.
Yeah.
It's a stock.
Yeah.
Oh, it is a stock.
Yeah. Correct charts. It's Pat.
Well, you must trade in harmony with the index. Now, I'm just trying to... slightly better, yeah. Now, this stock is obviously moving, appears to be moving with the index, which you say is a Nasdaq, but the Nasdaq also moves with the S&P and the Dow. There's a bit of weakness coming in there, look. There was a test there, look. It went up 1 bar and that's it. Right? And it's slowly rounding over here. This stock is obviously acting with the index, and the index at the moment does not look all that strong. Now I'm looking at these, I don't know, do people follow these diamonds? I mean, I don't know, Gavin uses them all the time, but I don't normally look at these diamonds. I'm trying to change it. How do you now do that, Peter? Change it from 20 to 6 or something. Ah, no, that's it, look. 6, put 6 up. Now, I've been looking at these diamonds here and there. I had these put in years ago. Admittedly, I don't follow them myself, but I've been looking at them recently. Gavin, for some unknown reason, always seems to want 20 up. But that's away from the market, look. And I think personally that if you use, say, 6, it's much more helpful. I mean, look, you suddenly get the white diamonds coming in early. And even the red diamonds are coming in, look, to warn you. Now that looks like a test there, but the volume really isn't low enough, look. So it's not a good test. I would say whatever we're looking at here is not particularly strong. It's acting in harmony with the index. If the index has a shakeout or some strength appears, then this will also show strength with it. Okay? Does that any help?
Edmund wants to know, are these diamonds moving average of price?
They are. It's based on somebody called Drummond first came up with the idea years and years ago. And I looked at this, I thought it was quite good. People seem to like these mechanical things. And it does seem to keep you more or less on track. So it's a fancy moving average. That's what that is. Okay?
Do we have BP? British Petroleum. Well, yeah. We can do, yeah, BP, British Petroleum.
Now, how many bars we got up here? So 20. Now, Peter just said, oh, the American one. Well, yes, it may be on, this is on the American exchange, but believe me, they're both, wherever it is, the FTSE or Singapore, wherever it is, it'll trade in harmony with the others. It has to because of these arbitrage traders. So it doesn't matter whether it's on the American market or the London market, doesn't make any difference. They will definitely move very closely together. And it's these arbitrage traders that do that. That's how they make their money. Right, so I've got 20 bars up, British Petroleum. Right, we obviously got some signs of weakness up here, look. There's no red arrows on there, but you can see that that's weakness. Right, and then you've got this red down bar. Look at that top tail to it. This is what we call, the mouse keeps jumping around. Look how that's gapped down. So this market is weak. Here we have an up bar, look. It's up on a narrow spread. It's been marked up but closed the lower half on very high volume, look. Or highish volume, relative to the previous volume. Don't forget, we look at relative volume. That's weak. That's why it's come off, look. Now here it looks like we got, yes, a little bit of stopping volume that's come in on that last bar. We have a down bar. The spread is narrow. It's closed just above the halfway mark. And the volume asset, that looks like there was some buying there. On that buying, you personally wouldn't buy anything because you'd expect this, if it was bullish, to go up a little bit, then test. Just like we've shown you on that 4-hour chart. Before they can go up, they want to know that that volume supply has disappeared. And they can only do that by going up a few bars and coming back down. But this looks weak. And you could easily draw a trend line. Can you draw a trend line between these two highs and that low? That's it. No, this is bar high. Sorry. Yeah. Yeah. No, low. That's it. Now that's a good trend. You can see it's trending down. However, some support has appeared. So it's unlikely to hit this lower trend line for the time being. But it's quite likely to go up to this trend line. It looks like some support's come in. But to be really bullish, you have to wait for that so-called testing of supply at that level. The market needs to go up a few bars, then back down to that level, and that high volume have disappeared. This, okay? So that's British Petroleum at the moment.
Has responded to the upside today. It's come into a previous area of supply from October 15th. That last bar is less than the supply on October the 15th, relatively speaking. Peter, do you want to point Tom to October the 15th?
Say it all again. Rita, say all that again.
It's come into a previous area of supply from October 15th, but the last bar is less than the supply on the 15th, relatively speaking.
Well, that's confusing the issue a little bit here, because that looks like a separate phase. Markets have phases, and you can see, if you look at this, you can see clearly that this is the phase here, look, this small distribution phase, and you can see that is a small accumulation phase. Now it's come up and come back down here. This is really probably not looking at this. It may do partly, I don't know, but I doubt it very much somehow. But you would expect, there was buying on there, you would expect some effort to go up. But it's not a full accumulation area, because we haven't seen climactic action or anything on the downside yet.
Edmund is saying you can show a weekly chart, but it still looks weak. Should we look at the weekly? Oh, we can't, can we? Can we? Yeah? Do you want to do that? We'll just look at the weekly chart. Say anything, Tom?
So this is a weekly chart of British Petroleum. Well, now the previous analyst mentioned that there was some buying on there, which there is, look. Not a lot, but there is, look. In other words, with markdown, it's closed top quarter on that excessive volume there must have been some buying. So it went back up, look. All right. I can't get the mouse to work. Yeah? Oh, yeah. Sorry. So it definitely looked like he was quite right. It wasn't buying it. You could see it more clearly on the weekly chart. So it went up, look. Now it's come back down to that area. Now, the thing is that the low of this is where that line is. And we're not quite there yet, but we're not far off it, look. Now, if that comes down to that line, right, and the volume remains low, then yes, there was some buying on that. But we knew there was some buying had come in from that daily chart that we looked at. It almost looks like bag holding, but it isn't. But it almost looks like it. That's what bag holding looks like. It's a gap down bar, and we talk about that daily chart again. Spread is narrow, volume very high. But the reason I'm reluctant to call it bag holding, there's no obvious stopping volume accumulation in the near background. And we saw the trend lines on that daily chart. Could you put that daily back up? I think I lost it. There we are. All we know from this daily chart is this looks like a separate phase up here. It's not a huge distribution area, but there is some distribution there. There's no demand here, which is, we draw the trend lines, right? But here, looks like support that's come in. Professional money has moved into that market. But before, you would expect some higher prices on that. But for a decent bull move, if it was bullish, then they'd have to come back down and test that level. And you should be able to see on the daily chart. Any more questions, Rita?
Let's have a look. Jenica's asking, wouldn't BP have some relation to crude oil futures being low? Yeah? Yep, so Tom's saying yes.
Well, don't forget arbitrage traders.
Yeah, you can speak, Tom.
Don't forget the army of arbitrage traders. And they will keep it in line. The future will run in line with the cash or spot because of the activity of these people. They buy one and sell the other, and they make a profit from the price difference. Now we can't do it because they have to do it in thousands of contracts to make any money apparently. But there are a lot of them around and they make money. They keep things in line. That's why the cash will run in line with the future. Now we'll be doing a newsletter Sunday. We got last Sunday out, okay? Hope you enjoyed it, those that read it. And I think it's time to wrap up now. So I say thank you very, very much for listening, and good luck in your trading. I shouldn't say luck. Recognize the principles. Do nothing until you see that, and then it turns the light on. But then your skills as a trader has to kick in as well. It's not all that easy trading, believe me. So I say thank you very much for listening. Good night.